Hello and welcome to episode 321 of the Money to the Masses podcast with your resident expert. As always, Damien Fay and me, Andy Leeks. Damien, welcome back. How are you doing?
Yeah, good. It's been an exciting week in investment markets, and funnily enough, what we're going to talk about this week has been, well, it kind of preempted some strong moves in a particular asset class, which I'll come on to. But there's been another great week in the Money to the Masses towers. Mugs galore. We've had loads of people write in trying to claim a mug. So I've got to get through that backlog. So if you've written in claiming a mug for a review that you may have done, then do bear with me. Sarah last week, we mentioned Sarah on the podcast, didn't we? And we joked that Sarah must be the happiest person going because we'd sent her a mug as well as answering her question. Well, she actually got in touch this week to say while she was listening to the podcast, the doorbell rang and our mug arrived. So it was almost like, magic. So we can't promise that will happen to everybody else, but it would be nice if it did.
And Sarah was good enough to send us a very happy photo of her with her thumbs up, clutching hold of her mug. So if any of you out there have received a mug recently and want to send us those happy mug shots, we will put you on our mug wall of fame, won't we?
We will do. And so please do send them in because we enjoy building the mug wall of fame and looking at your pictures.
And so you mentioned right off the bat at the start of the podcast about things that had happened in markets this week that, well, they've kind of forced our hand, haven't they? If we didn't do what we're doing this week, it would be a bit foolish. So what is it we've got coming
We're
up?
doing cryptocurrency and Bitcoin. This is pretty much going to be a 101 of cryptocurrency, and it's something I've been meaning to do for some time, and I plan to do it. But then this week, the Bitcoin markets pretty much imploded for 24 hours, and that was coincidental. But that means that before you start listening to the rest of the podcast, go grab a cup of tea, sit down, strap in. This is going to probably be a longer podcast than we usually do. But what I'm going to do is go through and explain cryptocurrencies, Bitcoin, how they work, pretty much all you need to know about the cryptocurrency world. And in particular, I'm going to focus on Bitcoin.
Okay, I'm going to assume that people have done that. They've paused the podcast, got themselves a drink. We've got our own drinks lined up here. We're sipping our own tea as we do this pod. So let's start from the start then. What is cryptocurrency?
Right, a cryptocurrency is a digital currency that can be used to buy or sell products and services online. And it's designed to usually be anonymous. That is part of the benefit. So if you think about the way currencies work in the real world, cryptocurrencies were supposed to be or are a form of currency that operates online, but it's decentralized, which is the key part about it. So that means, unlike the pound, which is controlled by the Bank of England, we've got a central bank, there's a banking system, and we have a government. So Bitcoin, for example, I'm going to focus mostly on Bitcoin, but it's transferable to all other coins that are out there, is independent of governments around the world and central banks. So it's a key part of it. And now that means that it's attractive for people who want to make anonymous transactions. And some people would say in its early days, and maybe still, there is an element of black market activity relating to that because you can make transactions anonymously. Now, that is true, obviously, up to a certain point, because for most people, if you're going to engage with these currencies, you normally do it through something called a cryptocurrency exchange. So think of it a bit like a platform. We'll come on to that a bit later, but you do register with them. So the point is, a cryptocurrency is a way of you being able to transact online with people all around the world to buy and sell things, and effectively it's not controlled by governments or central banks. It's anonymous. Now, how it works is important. People have heard of terminology like blockchain. So let me start with explaining what blockchain is, or what a blockchain is. Now, a blockchain is basically an online ledger. So think of it as an online ledger that records transactions in Bitcoin. I'm going to keep saying Bitcoin in my example, but every coin, so whether it's Bitcoin, whether it's Dogecoin, whether it's Ethereum, they all have their own blockchain. So think of it as a ledger where transactions are recorded. So movements of cryptocurrency between people, and it also records balances. So how this works is there's a network of computers out there, so around the world. So this ledger, this blockchain, is managed by a whole network of computers. So no one person has a copy of the ledger. That means that nobody can control that ledger. So no one person has it. What happens is they'll see a network of computers around the world who all have a copy of this central ledger that has the transactional information that I mentioned. And they are basically verifying against each other that they are consistent. If there's a change, you can't manipulate it in one place. You can't change it without anybody else realizing that there's been somebody trying to hack this ledger and change it falsely. So that's what makes it attractive. That's what makes it very secure. The reason it's called a blockchain is because there is essentially a chain of blocks. Each block contains the information of different transactions that have occurred out there. So again, I'm focusing on Bitcoin. The Bitcoin blockchain, each block will have details of transactions of Bitcoin moving between different digital wallets. Digital wallets I'll come on to in a minute, but think of it as Bitcoin moving between two people. So it's almost like a spreadsheet of information, transactional information. Now, what happens is when transactions are verified, they're put into a block, and that block is added on to a chain of the other blocks. So you can see that the ledger is continually expanding. Now, because of the way the transactions are added, the transactions can't be reversed. The information, once it's put on there, it's on there for good. So that makes it, again, very attractive if you're trying to track who owns what in terms of something like Bitcoin. Now, this corroborated ledger that's across a whole network of computers, blocks are added to it by what they're called miners. So think of it as this network of computers. Now, some of them will be mining. So this is where you hear the term mining Bitcoin. And what that means is they verify a series of transactions. And that's the first part of their mining job. So they verify this range of transactions that have occurred in Bitcoin, which I'm focusing on. Then there's a second part to their job as a miner. And what they have to do in order to add those transactions to the ledger, they have to solve an incredibly complex mathematical problem. And the mathematical problem produces something called a hexadecimal number. It's a 64-digit number, and it's called a hash. Now, to give you a comparison, it's a bit like me saying to you, tell me the number I'm thinking of. Now, there's a race between all the people out there who are mining. So there's this network of computers who are trying to crunch the numbers to work out the answer to this problem. So it's a bit like me saying, I'm thinking of a number and you're trying to guess it. And this number relates to the block of transactions that I have verified that occurred in the world of Bitcoin. Now, at some point, someone will get the right number. And in order to try and crunch the numbers, because a hexadecimal number is effectively, it will be a number that's a string of numbers and letters. So numbers 0 to 9 and letters A to F. So it almost is a bit of a game of guesswork. But in order to try and work out what that number is, it's a real mathematical puzzle. So it requires lots of computing power. Now, this is where you hear the stories about Bitcoin mining being bad for the environment, because in order to solve that problem, then you're going to need huge computing power to be able to crunch all those numbers. And you think about it, if I'm talking about a 64-digit number that can include numbers and letters, that is something that's going to be very hard to work out. And so in order to run these very powerful computers, you need a lot of electricity. You've got to cool them down because they could overheat. And so as it stands, I've seen statistics that suggest that Bitcoin mining around the world uses about half the electricity that the whole of the UK does. Wow. So that's why it's bad for the environment.
I do find that whole aspect of Bitcoin mining and the energy usage a bit bizarre, because the whole concept of Bitcoin or cryptocurrency is that it's not tangible. It kind of doesn't exist. But obviously, the energy usage is a very tangible thing. It's something that actually does happen and you can see and feel. And do you know what I mean? I find that strange.
And that is one of the downsides of it. And it's come to the fore with Elon Musk was tweeting about it recently. And it was part of the reason we saw a crash in Bitcoin this week. What happens is one of the miners will eventually get the correct number. And then they will win. It's like being at the bingo. I'm using analogies here. It's not really, but imagine they won house. Then it's quickly verified by other people on the network. And by them solving the mathematical problem, they win the right to put their block onto the blockchain. So those transactions that were verified, they can put them on the blockchain. And in doing that, they then get rewarded, and they get rewarded at this point in time with 6.25 bitcoins. That's the reward, and they're brand new, so they're mined. That's hence the terminology. But they also get a small fee from every transaction which they've put in their block, they've added to the ledger. So that is another benefit of doing it. And the reason this works is it encourages people to maintain the ledger, the blockchain, and it therefore enhances its security because people are maintaining it and improving it over time. So that is what blockchain is. It's basically a ledger that's online, that's maintained by people who are rewarded for doing that. Now, every coin has its own blockchain, like I mentioned. So Bitcoin has its own one, Ethereum has its own one, Dogecoin has its own one. Now, with Bitcoin, I mentioned that reward. What is interesting, there's so many rules that are baked into the Bitcoin world. So Bitcoin was created, well, it's a person, whether it's a person or a group, called Satoshi Nakamoto back in 2009. So it's a kind of almost like it feels like a bit of a myth. No one knows who that person is. And they created the algorithm and everything to make Bitcoin, and built into that certain rules. And one of the rules is the reward that people get for mining Bitcoin. And every 210,000 blocks that are added to the blockchain. So basically, as the online ledger of the record of all the transactions in Bitcoin gets to a certain point, then the reward that miners get halves. That means roughly every 4 years, because that's the time it will take to get to that 210,000 new blocks, the reward halves. So you don't get as much reward from mining.
And is that purely down to numbers because there's more in existence, and so there's less value to it?
Yeah, it's baked into the whole system. And one of the other things to mention, which is again just an interesting fact, the maths problem that I mentioned that's part of the mining process. And the reason people might think, well, if somebody wants to add these blocks and these transactions, why do they have to solve a puzzle? And the reason they have to solve the puzzle is a verification that they've done the work, essentially. And that puzzle gets harder and harder the more people who mine. So the more people, it's a bit like saying in a gold rush, the more people that were digging in the mines, in fact, the amount of gold is actually getting harder to find. That would be an analogy. That isn't perfect because the amount of gold is static. It's whatever's in the mine. But in terms of Bitcoin, the reward does diminish. And so that is baked into it. And Bitcoin has a maximum amount of Bitcoins that there will ever be. And that's 21 million Bitcoins. And that means that by the time we get to roughly 2140, the year 2140, then we'll hit the ceiling of the amount of Bitcoins in circulation. And the reason why all these things are baked into the algorithm and the way Bitcoin operates is to ensure that there's some mitigation of inflation because of the limited supply of Bitcoins. And it also ensures that the ledger grows at a stable rate and new Bitcoins are added to the universe of Bitcoins or available Bitcoins out there at a stable rate, because otherwise everyone would just quickly mine it all and the whole thing would break down. Because don't forget, this is a ledger that we've got that they were building over time.
Maybe I've been watching too many movies and about villains and superheroes, but what is stopping someone creating, because technology improves over time, and this was created back in 2009. So what happens if technology improves, someone creates a supercomputer that has an amazing amount of processing power that can basically speed up this process, or can that not happen?
Yeah, so it's a great question, because what happens in the early days of Bitcoin mining, so when Bitcoin was in its infancy, you could have mined Bitcoin, because don't forget the computer programs that effectively were doing the mining, crunching numbers. That's all the mining is. You could do that on a standard computer. So as time's gone on, the processing power that's needed, because as I mentioned before, the puzzle gets harder to solve because it's directly related to the amount of computer power that is being used to solve the puzzle.
You kind of answered my question a minute ago, and I've used an example, and you've answered.
Yeah, but it's bang. What's important about what you've just mentioned is that people are doing that. So there is a race of different. I'm not going to get into the different types of mining rigs. So a mining rig is all this terminology that comes in that you can see where it kind of comes from. But if you think about a computer, would be just like a CPU, a computer, and it'd be using the chips that are in the computer. That would be maybe a CPU rig. There are different types of rigs that have basically computer processing or things that are made specifically to mine Bitcoin, i.e. to crack that mathematical puzzle, and they require huge amounts of energy. And so people have come along and they have created these huge things. And there is a bit of debate in the community whether that's right or not. People also do something called pooling. So let's imagine me and you had our own means of having some really powerful computing stuff, and we pooled our resources and shared our rewards.
Yeah.
That happens. But there are ways to do that online in mass groups. So you'll get websites that do it. But also there's cloud computing. So you can decide, I want to get into Bitcoin mining. Rather than having to buy all the expensive gear, you effectively rent somebody else's. And they are what are called Bitcoin mining farms that are all basic huge computer networks all around the world. And you effectively fund part of that, and you share in a proportion of the reward relating to how much you're funding it. And you can rent for maybe a period of time up to 2 years.
In real mining, I say real mining, in old school mining, that still happens. People have land, but they don't necessarily have the machines and the rigs and the people, and they'd rent out that land for a proportion of the royalties. And I suppose it's a similar thing with cryptocurrencies.
Yeah, and so the whole thing is set up to try and maintain some element of fairness in the sort of mining process. But let's be honest, for ordinary people, it's now getting to the point where you're not realistically going to be able to mine Bitcoin on your own in your bedroom, because not only that, you've got to look at the amounts of power that it uses. You're going to end up having an extortionate electricity bills, because in order to run these things, like to give you an example, like now, if you try to mine on a normal, even the best laptops, computers you'd have, it'd basically melt the thing. It would end up the cooling that you need to be able to stop the thing overheating, trying to process, it would just bring it to a halt. That's the kind of level of computing that's going on. And most of the mining actually occurs in China, even though China this week came out and actually said to institutions not to get involved in cryptocurrency transactions, which caused the price to slump, as we saw on a day, which we can mention towards the end of the podcast. So that is how Bitcoin works. I've described what blockchains are. It's important you need to know what they are, because you will have heard of things like I said, different coins, altcoins people call them. That'd be Ethereum, basically anything that's not Bitcoin.
Alt meaning alternative, right?
Yeah,
Okay.
and so it's just, but people might be listening to this podcast and go, well, I've heard of tokens. So what's a token and how's that different to a cryptocurrency coin? Now, the reason I talked about blockchain at the beginning is because you need to understand that before you can understand what a token is. Now, a blockchain, as I say, is a central ledger that grows over time as more and more transactions are made in a given cryptocurrency. The Bitcoin will work on a Bitcoin blockchain. The Dogecoin will work on a Dogecoin blockchain. And usually the only thing that is recorded on the blockchain are transactions of the coin. So in terms of Bitcoin, the blockchain is just a ledger of transactions in Bitcoins. That's because it's the only asset, the way it was designed, that it can track. Now, Ethereum, which is another cryptocurrency, what is interesting about that universe is that that blockchain, which that currency obviously utilizes, is something called a smart contract blockchain. And that means that it can actually be used to track other assets. It could be used as a ledger for things other than just Ethereum coins. And this is where tokens come in, because in theory, on that particular blockchain, the Ethereum blockchain, you could record an asset or transactions in any asset. And we're talking about real world assets. So let me jump forward into the future. In theory, you could use the Ethereum blockchain to track transactions in something like property. And the way you would represent that particular asset, that's a real world asset or other type of asset on Ethereum, is something called a token. So that token represents another type of asset. And to give an example of property, in the future, there's nothing to say that we won't start using the blockchain, the Ethereum blockchain, to be able to transact in property. So rather than the convoluted way we do things with conveyancing and land registry and everything like that, you could, in theory, move assets from one person to another, because the transaction would be recorded via tokens on a smart contract blockchain like Ethereum. That's why everybody's getting a little bit excited about Ethereum and that particular universe. Now, you will have heard of NFTs, and people have been sitting there going on about, or have heard news stories about tweets being sold online and people buying them at auction and thinking, what the hell is all that about? Well, this is where tokens come in. So there are two types of tokens. There are NFTs, non-fungible tokens, and then they're the other type, which are fungible tokens. An non-fungible token, an NFT, that is usually used, if you think about it, to represent something that's pretty much unique. So think of it as my house. There's only one house like mine. It inhabits the space. There can't be another house on the same bit of land as my house because my house is there. So therefore, an NFT can be used to confer ownership of something that is pretty much unique. The Mona Lisa, you could have a token to show who owned that, and it could be transacted in ownership, move from one person to another. That is what's exciting about NFTs, because it could enable some real world opportunities. Like, you could have crazy stuff go on in the future that everything you buy could, in theory, have some kind of token that is associated with it in physically, but that token in the digital world can be tracked on a blockchain of some kind. And so therefore, if I lent you my lawnmower, then that transaction almost of me lending it to you could be recorded on some kind of ledger online. So in theory, this could have huge opportunities.
Is there not a slight flaw in the anonymous aspect of these ledgers? Because you mentioned earlier about the Bitcoin and it being done anonymously. Does that not cause a problem when you're trying to track assets and things like that?
Yeah, so I'm going to come on to wallets in a minute, but essentially when you look at a blockchain, you think of it like a spreadsheet. And what it does is it says there's a transaction gone from this wallet to another wallet, and it's almost like a string of numbers. So it doesn't say who owns that wallet. You don't even know how many wallets are in existence, because wallets are essentially where your currency or whatever will live, your token or whatever it is. So it's a series of transactions. But for most people who will go and interact with this world of cryptocurrency, they will do it through something like a cryptocurrency exchange. So think of it as a parallel universe to things like investment platforms. So you think about, you want to buy funds, you might go to Hargreaves Lansdown or Fidelity. There are things like that in the crypto world. eToro will allow you to buy and sell Bitcoin, for example. But in order to have an account with them, you're going to have to do the same money laundering stuff that we would do for other more standardized platforms, things that you would normally use. So there are other platforms like things like Coinbase. So if you think about it, given that a transaction occurs in the crypto world and it might be a string of numbers, they will eventually be associated with an account somewhere that is associated with Andy Leaks, and therefore it starts to reduce that anonymous element to it for ordinary people. So I think that isn't going to be such a problem. It's one of those things that in order for it to go mainstream, we kind of need to not have that in it to the same degree. We can't have it completely anonymous.
Yeah.
But it does raise an interesting point, because everything that's on that blockchain can be viewed by other people. So you can view the transactions that are going on, but you
just
won't,
in terms of ID numbers, right?
Yeah, so you don't know who necessarily owns those, but it's one of the reasons why people who have big Bitcoin balances, for example, won't want to boast about it online, because that will start to raise the interest of perhaps some parties that might be a bit shady, because it's a bit like you shouting you've got a big bank balance and they can kind of see transactions, not quite see who owns stuff. You start to be able to tally stuff up. So if you do have big Bitcoin balances, don't shout about it online. So going back to the NFTs, they are things that would maybe be assets, like some people might have artwork, for example. They could be an NFT. But what happened with things like the tweets, people wanted to own that piece of history. And it seems a bit bizarre. Why would you want to own a tweet? Because anyone can look at it and do whatever. But it's the same logic as to why anybody would want to own the Mona Lisa, because you can go and buy a print of the Mona Lisa down the shop, but you don't own it. So there is still that element that somebody wants to be able to say that they own it and they can look at the true original version of something, even if that's digital. So it is odd to all of us, but it's just a parallel universe of, at some point, someone would actually own the first digital copy of a tweet. And so that has some value. And if you associate a token with that, then it can be tracked who actually owns it. But you've got the other type of token, which is a fungible token, which really represents things that are pretty much all alike. So imagine if you had a share in Apple, so Apple shares, it's a bit like a share certificate. So if you have one of them, you've got one share. If you've got two of them, you've got two shares, and they can move around. You don't need to get the same token back. It represents the same thing in maybe the real world or electronically. So that is the difference, just a bit of terminology there. Now, what is interesting about tokens is they can then lend themselves. You might be sitting there thinking, well, that's interesting. If a token can represent pretty much anything you want, well, why wouldn't you make it represent a real world currency then? And the answer is that already happened. So that's called a stable coin. And so if you followed me so far, that a stable coin is not a coin in the true sense. It's a token. And what it is, there are some out there that work where one of these stable coins is equivalent to a US dollar. It's a 1-for-1. So you pay
at whatever price the US dollar, it tracks the US dollar as it goes up and down.
Yeah, so that's why it's called stable coin. Correct. Because it means that if you give your dollar and you get one of these coins, if you decide to don't want that digital coin anymore, you get your dollar back. So it means that you've got a means of transacting online digitally in a stable way. And they already exist. And this will be probably a precursor to what maybe central banks will do in the future when they want to try and create a cryptocurrency of their own, because it's a bit more stable. And the reason they exist is because people can then use them as transactions. The problem with Bitcoin and other coins, if you look at what happened this week when we saw in one day the price fall 30%, and over the last couple of weeks it's fallen more than 40%, but then in the same day go 30, up another 20, down another 10, that makes buying anything very, very difficult. You imagine you wanted to buy something in Bitcoin. By the time you've got to the checkout, the price has either plummeted or gone up in when you convert it back into, say, dollars. That is very hard.
And I imagine this is the trouble that Elon Musk ran into. He might say that for whatever reasons, it's due to environmental reasons that he's kind of taking a bit more of a backseat. But let's be honest, if he's accepting Bitcoin as payment and Bitcoin's going unbelievably up and down, surely that can't be good business for him.
Well, yeah, exactly. It's very hard to be able to transact in it. And I mean, in time, that problem they might have some solutions to it, and you can already transact in it. I'm going to mention a couple of ways a little bit later. So you can use Bitcoin, but it doesn't lend itself as well to a normal currency.
Great. So, I mean, I'm learning as I go along here, and I'm going to ask these questions as I think of them. So sorry if it's a stupid question, but I understand now what coins are and what tokens are. How do they interact on these blockchains? Because they're two different things, right?
Yeah. So if you recall when I talked about the blockchain works by being effectively maintained by a whole network of computers, of which there will be a subset who are mining, and it's really maintaining and adding the transactions to this online ledger. And the way they're rewarded is by being paid in the native coin of that blockchain. So in Ethereum, if you think about it, anything that's using NFTs, tokens, or whatever on that blockchain, it still comes back to the point that they're going to be paid in the coin that is native to that particular chain, which is Ether. So that is how they interact. So they've got a purpose, because you can't use and interact with tokens unless there is going to be some reward for the people who are maintaining the ledger, and they need to get paid in the coins. And of course, all these coins, when you think about Bitcoin, Ether, all of them, they all have different values and vary. And to answer a question that some people are thinking is, well, what determines that value? Again, it's perception. So sometimes it's about which type of cryptocurrency people think will become dominant, or it might be the next phase of development, like Ethereum is now quite popular. People might be drawn to that. It might be a whole host of reasons, but as you see, it's very volatile. And Bitcoin is a bit of the sort of granddad of the sector at the moment. And some people are being more attracted to some of the other alternatives, maybe because of energy reasons, because others might have a more efficient way of being mined. That they all work in similar ways. There are differences. I'm focused on Bitcoin about how this all works, but there are similarities in the space. But I want to quickly talk about wallets. And the reason I want to talk about wallets is because it sounds quite simple, and at its core it is, but there are some nuances. And there are people who've heard about public and private keys. I'm just trying to cover off as many key terms so people can go, oh, right, at least I kind of get that. Now, a bit like you've got money, you might put it in a wallet in the real world. Bitcoin cryptocurrency works in a similar way. So you have to have somewhere where that money could effectively go. Now, you will read articles that say, right, your Bitcoin is stored in your wallet and then you can go and spend and whatever you have with them. That is technically not true. The wallet, you think of it functioning like a wallet, but what it really does is it allows you to interact with the blockchain. Because don't forget, that's the ledger. The Bitcoin live on the blockchain. The blockchain is a list of transactions and balances. So when you make a transaction, the blockchain will be updated and therefore it'll be verified. And that's how you'll know how many Bitcoins you can spend, etc., etc. And so the wallet, the way it works is that every wallet has an address. So think of it like your sort code and account number on a bank card. With that information, people can pay money into it. That is information you are happy to give out to people publicly. Now, that is kind of what happens with addresses on digital wallets. People can send cryptocurrency to you using that. Now, with a wallet, there are two things to bear in mind. There's a public key and a private key. The public key is effectively like the address. It's not actually the address. You derive the address, like that sort code and account number, from the public key. But to all intents and purposes, it's the bit that's facing out, and people can see that, and that's how they can interact with you and give you cryptocurrency.
A unique identifier, basically, for that.
So, but as you were talking about earlier on about that being anonymous, there is no track of who owns a wallet. And the way it works is I mentioned a public key and a private key. So it's a bit like having two keys, but they're associated. And so in order to use your Bitcoin that I'm doing inverted commas that are basically in your wallet, you have to prove ownership via this private key, which is again a long string of effectively characters. And that is where people come a cropper, because if you lose that, that stops you being able to use your Bitcoin. People can keep paying Bitcoin across to you. Transactions keep going, and you can send them across to this public address, your wallet effectively, but you can't use them because you haven't got the private key. And like I say, in reality, the wallet just allows you to kind of go in and interact with the blockchain. So there are people who've lost those keys. And if you lose those keys, think of it like a bank account. If you lose your PIN number, when you go to use your debit card, you have to enter a PIN number. And that's a proof of ownership of the card and of the bank account, and you can do what you want. It's a kind of, not a perfect analogy, but it's a similar thing. The private key, this password, you have to put in when you're using your Bitcoin. You want to use your Bitcoin. And if you get the PIN wrong on your debit card when you go to the shops, you get a bit of and you can't use it. Difference is, in that world, you can eventually prove to the bank that I own this. This is my bank account. Can you reset the PIN? And they'll go, yeah, of course, we'll reset the PIN. In the world of a decentralized currency, because no one is owning it, no one can manipulate it. That's by design. There's nobody to go and reset this.
There's no live chat.
There's no Bitcoin live chat. And that's why you need to be able to record that password, which is a huge string of numbers and digits, in order to access them. And that's why you see the news littered with stories of people who lose that and then their Bitcoin is lost. And that's what effectively is, they are lost. It's gone. You can't access it. Now, there are ways of having different wallets. You can have an online wallet, so it lives online. You can have it like in an app. They're called hot wallets because effectively they're connected to the internet, and therefore that makes them vulnerable. You can have cold wallets. So you could have, say, a USB stick where the details of effectively that key live on that card, which you can pull out, put it wherever you want. Then nobody could go and try and claim ownership by having stolen your key and saying that wallet's mine online. And so that's called a cold wallet. Go one stage further. You could actually just print it out. You can have a piece of paper that's got the code on it and you're not connected at all. But people can keep sending money to the public address of that wallet until you then want to decide to go online and then want to interact with it and be able to spend it. Then you would use the key you've written down. Some of the services, if you're using them, do allow you to have like almost password recovery. So they'll give you a string. It's a bit like two-step authentication. When you turn that on like your email, they normally give you a means of recovering it by giving you a one-time type of code or string of words, which is your last hope. You have to put that somewhere, and if you haven't got that, then you'll never recover it. So there are some get out of jail cards when it comes to wallets, but that is what a wallet is. And so going back to the blockchain is just a list of, effectively just a list of transactions between two wallets. And that's why it's important that you don't lose your key, because it's the only way of proving that you own those Bitcoins. Now, there has been questions raised about some of the online services, though you'll use crypto exchanges if you want to buy and sell Bitcoins, where they will have a wallet, but they don't tell you the private key and you can't see it. It's kind of all just encoded on there for ease of use. Well, that's a vulnerability, because if someone hacks that and they get hold of that key, then they can own it. And like I said, all the transactions are visible on the blockchain. And that's why, if you've got lots of Bitcoins, don't go shouting about it, because obviously people can use that to try and identify who you are and then maybe try and get hold of your private key. And so one of the things that people who are into cryptocurrency will do is they might use a wallet that's not associated with a crypto exchange. So therefore there's an element of distance and they have a bit more security, because although blockchains are secure, the weak link is always the way you access them. And we've heard stories of exchanges getting hacked into in the past and people losing all their money or their Bitcoin. So it's not unheard of. So there are ways around it and security. So I want to finish up on just the kind of how you use it. You can use, there are crypto-friendly debit cards out there now. And we've got an article we'll link to that details some of them and how they work. And that means you can, in a way, it links like a debit card, and you can buy things but with Bitcoin or cryptocurrency of some kind. There are also retailers who do accept Bitcoins directly at their checkouts. Microsoft is one example. Again, the article we will link to details some of the others that do. And of course, you can trade. You can buy and sell Bitcoin if you want to. And you do that through a exchange like Coinbase, like eToro, like Kraken. And we're not going to dwell on those anymore because we've covered a hell of a lot in this podcast. But I hope that people listen to this, it's given them a good enough understanding. I have summarized bits of it, so I haven't gone into exact detail, 100% accurate, but it gives people an understanding of how cryptocurrencies work, how Bitcoin works, what wallets are, what the keys are, all those tiny details that actually matter if you're going to go and try and explore this world of cryptocurrency.
Excellent. One thing I love about this podcast, Damien, is the fact that you do the research, you understand it far better than I do. And often I'm just sitting here learning as I go along. And that's exactly what's happened today. I had no idea what wallets were, had no idea what tokens were. I get it. At the start of the podcast, though, you mentioned about the volatility of Bitcoin in particular this week. What caused that particularly?
Well, in this instance, it was down to, Elon Musk has been a bit of an advocate in this year about Bitcoin. He was going to accept Bitcoin as payment for Tesla. So if you want to buy a car, you could use Bitcoin. So again, this universe isn't going anywhere in terms of cryptocurrency. And over time, more and more ways of using it are going to come about. And Tesla was kind of one of the early adopters of this trend of paying in Bitcoin. And that sent the price of Bitcoin higher. And of course, they bought a load of Bitcoin too. Now, what we've seen in the last week is that Elon Musk then came out and said they wouldn't be accepting Bitcoin anymore as payment because of the concerns regarding the energy use and the damage to the environment that Bitcoin mining causes. And that then started to set the Bitcoin price on a bit of a downward slant. It'd already been falling, to be honest, because when the Coinbase exchange floated, that was almost it was almost like a high in the market. It was almost a bit of a peak, and then it kind of enthusiasm started to wane slightly. And then this week with China, the authorities came out and said that institutions should refrain from transacting in cryptocurrencies. Basically, if you read the headlines, they're trying to clamp down on it. And there are fears that that was going to escalate elsewhere in the world. I saw a headline before we started this podcast with sort of some similar rumours in the US. But obviously, if the second biggest economy in the world starts to clamp down on use of cryptocurrency, then that would cause a problem. It caused the market to fall. Bitcoin went through a key support line. I talk about them on midweek markets. And then it was in free fall, and it fell like about 30% in a day. And then it rebounded, and we recovered some of that loss, but by no means all of it. So that is the problem with cryptocurrencies, they are incredibly volatile. They're not like a normal currency won't move based on a headline like that, not typically. So with Bitcoin, it's a wild ride. I mean, it's unbelievably wild, which means for most people listening to this podcast, steer clear of it. The reason I'm doing this podcast is an education piece because you don't want to be ignorant of an asset class. And as I've mentioned, it has started to gain traction in people's portfolios and in big investment companies' portfolios as an inflation hedge. But this is the problem with cryptocurrencies. They are very sentimental. The price moves are very almost emotional and subject to headlines like we saw. So you're going to see more of that. And there's a great chart I've seen that goes back over the years and highlights all the kind of 30-40% drops you've seen in crypto, particularly Bitcoin, and they happen at regular intervals. It's not like in equities where to get a massive bear market happens periodically, maybe typically every sort of decade, where you get a really severe sell-off. Bitcoin happens much more frequently. And just to give you a highlight, we had a bear and bull market in one day in Bitcoin. So it's like equity markets, but with the speed and volume turned up to 100.
Okay, well, I enjoyed that. I enjoyed being along for the ride. I learnt a lot as well, and hopefully our listeners will have done too. So if you've got any more questions, whether it's on cryptocurrencies or around it, do feel free to sort of fire them over. Obviously, we can't answer every question specifically, but if it creates, something that we end up writing an article on or doing a subsequent podcast, of course, you can always ask those questions in the group as well. So that's facebook.com/groups/money to the masses.
And to add to that, we are going to be writing more and more on this part of the world because it's a growing trend. It's, like I say, it's not about to disappear overnight, but people need to be educated on what it is, how it works, even if that is just to make them realise it's not something they would necessarily want to get into.
Okay, so that's it. We're pretty much done for this week. If you want to get in touch with Damien, you can do so in the usual ways. It's Damien@moneytothemasses.com. If you want to drop me a line, you can. It's Andy@moneytothemasses.com. Twitter, it's @moneytothemasses with the number 2. And finally, if you could review the podcast, that would be amazing. We may well deem that mug worthy and be sending out a mug if we read it out on the podcast and you claim that as your review.
Yeah, so that is it. Until next time.
Until next time.